Okay, folks, welcome to Stock Charts Today. This is Bob Desmond, and welcome to silly season. Today marks the big kickoff of the bank earnings, and of course, CNBC has already begun their propaganda machine. JP Morgan has yet to report, but already they have a headline on CNBC.com. Bank earnings are coming, and they are going to be huge. Now you know why I covered my short position on the banks yesterday. We'll take a look at a chart of JP Morgan in a moment. Let's get to a headline this morning on Zero Hedge. Chapter 11 bankruptcy spiked 63% from a year ago. A huge move. And what's even more significant is that we are at highs not seen since April of 2011 with regards to Chapter 11 bankruptcy filings. Now, the culprit, if you do a deep dive into the numbers here, is the retail sector. A lot of brick and mortar shops going under. This is not going to help Amazon at all. You already have the President of the United States leaning into Jeff Bezos, and this may become a bipartisan issue. Why? It's because there are brick and mortar shops in Democratic districts as well. There are also employees in retail stores who are making minimum wage and who would generally vote Democrat. Now, while I do not believe that Amazon is the proximate reason why all of these companies are going under, I do think that Amazon is visible, highly popular, and they're an easy target for the politicians, especially as we approach the midterms. Now, what is also important, I was listening to Bloomberg, and this is the second time I heard this yesterday, was that our subprime auto loans are at the highest default level since the financial crisis, and they are spiking higher than the financial crisis. So you're seeing a surge in bankruptcies, you're seeing a surge in defaults on subprime loans in the auto market, very reminiscent of the 2007-2008 financial crisis. Let's keep an eye on these emerging stories, because you're not going to see it on CNBC. They're going to give you pump and dump. Nothing about above the fold here. Nothing about Chapter 11 bankruptcy filings at multi-year highs. Nothing about auto delinquencies surging. But subprime mortgages, they're making a comeback on strong demand. That they'll publish. Nothing about the defaults. It's all good. Amazing. And they talk about fake news. All right, we're going to switch things up here a bit. I'm going to go to member stock chart requests, and then we'll segue into the pre-market activity. I want to see whether or not JP Morgan reports earnings. So let's kick things off with two charts from fellow member Rakesh. Good charts, Rakesh. Good eye, as usual. And the first chart up is XNCR, weekly chart. We are right at a breakout point here. One could argue that we are breaking out. I'd rather stay conservative and say we are at a breakout point. The S&P 500 is overlaid here in black, and we are outperforming the S&P 500 by a long shot. So we have relative strength, not to be confused with the relative strength indicator. We have relative strength versus the S&P 500. So the weekly chart is looking good. Daily chart, we broke out of this consolidation range, and we did so handsomely. On Wednesday, we flashed a bearish reversal bar, but we reversed that reversal bar on Thursday, but we did not make a new daily high. We have resistance at 30.57. I'd be a buyer of the shares on a close above 30.57. So how I would play it is that I would wait until the final moments of trade, execute the trade if we close above 30.57, or I would wait until next week and open up a position if we get a new weekly high. Keep an eye, though, that we do have very thin volume here. I would use a limit order, not a market order, when executing this trade. And I would wait, of course, again, to the final minutes of trade to ensure that we don't have a whale, an institution out there looking to dump a whole bunch of shares into the close. The next chart up, also for Rakesh, CRC, California Resources, a really good chart. We were in a multi-year triangle formation. That all ended back here in November of 17 when we broke out. We rallied up to resistance at 25.06. We did not break out and close above the prior high at that resistance level at 25.50. Now, we did pull back and we put in a higher low off of support. Good stuff. We also, when we broke out in November, we rallied, we pulled back, we retested the breakout point. Also very good. So you're seeing a lot of tests done here after the breakout. That's really what you want to see. What they're doing, what traders are doing, they're validating the breakout. What's missing here is a close above 25.50. So we have a half a breakout going on. What we have here is higher lows getting put in. What we're lacking is a new closing high. Once we get a close above 25.50, then traders will take notice of the shares. So the chart is looking good. Volume is poised to come in about average. Daily chart. So a little bit of topping action here on these candlesticks. You see the topping tails or wicks. I wouldn't buy until we could either A, make a new closing high and close at the highs of the day, or B, pull back and retest the support level. Volume yesterday was very light. So just be forewarned. Stokes are looking good. I like both of these charts. Good stuff. Nice eye, Rakesh. Let's take a look at the pre-market activity. Let's kick things off with JP Morgan. It's up over $1 in the pre-market. We do not have earnings out as of yet, but it's up in the pre-market. The S&P 500 moving higher this morning by about a quarter percentage point. We covered our shorts yesterday on the S&P 500. What we continue to see here, though, are closes off the highs of the day. The NASDAQ composite, it is moving higher off the lows of the day. It's still down on the session, but it's off the lows of the session. And we are breaking out on a 4-hour chart. Now, on both the NASDAQ and the S&P 500, we have nice sound bases, and we're beginning to break out of those bases. That's why we closed out our short positions. Now, these are 4-hour charts, not daily charts, not weekly charts. The daily and weekly charts still have some problems with them, but the bias in the short term is to the upside. NASDAQ just went positive, which is why we closed out our short positions, and I'm open to reopening those short positions in the coming days. But with silly season upon us, meaning earnings season, I would prefer to not be exposed to the short side. Now, once we get a good feel for how earnings are rolling out, and I really don't care about the earnings per share, I care more about sales and margins, because earnings can be manipulated. Sales, that's a different story. Margins, that's a different story. So we'll be watching those two metrics as we do every earnings period. Take note of the Bollingers ever tightening and hooking up on the NASDAQ. So the bias is to the upside for the S&P and the NASDAQ this morning. Let's take a look at the dollar. The dollar opened up strong. I predicted Wednesday with members that we would get a rally in the dollar. We got that rally yesterday. Now, the financial news media always loves to give a reason as to why they believe a stock or a currency rallied, and the reason was weak euro due to dovish minutes out of the ECB from last month. Also, the fact that the tensions with Syria have seemed to have simmered down some. Net, though, we closed off the highs of the day yesterday. We're consolidating. If we break down below this lower band of support, I think we're going to take out recent lows on the dollar and head considerably lower. Now, if we rally up and through and close above this upper band of resistance, well, there's a cause for concern, because that will take us in all probability up above 90, which is a psychological resistance level. So more to come, members, this weekend on the dollar, along with our positions and market pulse check, which is where we review the health of the overall markets on the week ahead commentary coming out on Sunday. Now, what do I want to buy if the dollar fails to continue to break out here? Gold. People don't appreciate the fact that the price action this week saw a significant event for gold in 2018. What did it do? On Wednesday, gold hit a high intraday not seen since July of 2017. Profit takers and overhead supply took gold off the highs of the session. We're now bouncing back some, but a significant event this week on gold. And if the dollar breaks down yet again, you're going to see gold move higher. Also, coming off the lows of the session, silver. We were flirting earlier with attempting to close above this 4-hour period, above this resistance level. At current, it is failing to do so. We are up higher on the session. We will be watching silver, gold, and the dollar in particular. Let's take a look at JP Morgan, see whether or not they've reported. Nothing yet. Now, the thing to watch with JP Morgan today is, let's say that they come out and they beat the street's expectations on earnings. We are up in the pre-market. Does it sell off or does it rally? If we see a trend of stocks selling off on earnings that are coming in better than expected, that's a problem. Now, remember, a lot of these banks and a lot of these companies, they have the analysts lower their expectations for earnings. That way they're able to manage their beats by the street, but they're not fooling everyone. So if the stocks begin to sell off on earnings beats, you need to watch, really take a close look at their revenues and their margins. That's it for this morning, folks. Best stock charts is coming out tomorrow. Those are the stocks that we're looking to trade next coming week. If you want that analysis, go to the website, enter your email address. We hate spam too. That'll be going out to non-members. Members, we will send out the week ahead commentary on Sunday, which is a 45-minute video recapping the health of the overall market, a review of our positions, and our strategy for the coming week, as well as a deep dive into best stock charts. Everybody have a profitable trading day and have a great weekend. Be well.